So I'm just going to explain about the direct labor budget. So at a Royal Company, each unit of product required zero point zero 0.05 hours of direct labor. So keep one thing in your mind. This is 0.05 hours, not rate, right? It's not in dollar, but this is in hours. So it means there are a number of product that uh, we have budgeted, right? So for each unit of product, we require this much of time, means number of hours, 0.05 of the direct labor. So the company has a no layoff policy. So all employees will be paid for 40 hours of work each week. In exchange for no layoff policy, workers agreed to a wage rate of $10 per hour, regardless of the hours worked. Means if there is the overtime will not be paid, right? So whether they are working for 8 hours, whether they are working for even less than or more than, but the company is going to pay the 8 hours pay. For the next 3 months, the direct labor workforce will be paid for a minimum of 1,500 hours per month. So here we are not considering, or there may be one employee or two employees, but we are considering 1,500 hours per month. So will be allotted to the whole workforce in our organization in the manufacturing process. So let's have a look. So we know that 26,000, 46,000, and 29,000. These are the three months units that the production is required and estimated. So direct labor hours, we know that how to calculate the direct labor hours. So direct labor hours, if we say, so that will be, if we multiply with 0.05, then we come to know that labor hours required. So this much of labor hours required in our factory, right, in the manufacturing process. But the guaranteed labor hours that is already given, that is 1,500. So 1,500 hours, which is already here, you can see that there is some difference. So whichever is higher, the higher of the labor hours required or labor hours granted. So no doubt the guarantee means the minimum. Minimum is the 1,500, but if it is going beyond this one, that will be considered. So in this case, in both, 1,500 is higher than this one, here 2,300, and here 1,500 once again. So the labor hours paid, right? So 1,500, 23, and 15 total is equal to 5,300 total hours for the quarter. Now wage rate, which is already given to us, that is the $10. So if we are going to multiply this wage rate with the labor hour paid, then we will come to know the direct labor cost. It means for each employees, or for total number of employees, means to the workforce, we will be able to pay, or we are expecting to pay $53,000 for this quarter as a direct labor. Now, what would be the total direct labor cost for the quarter, right? If the company allows its no layoff policy, but pay $15 times and a half, mean 1.5, right? Mean $15 for every hour worked in excess of 1,500 hours in a month. For example, here in this case, that labor hours required, that was 1,300, right? But if in case employees work more than 1,500 hours, then the organization, that company, will pay $15 per hour. So now in this case, what is expected from you, that what would be the total direct labor cost for the quarter if in case this is the modification? If the company follows its no layoff policy, that is fine, means no one is going to be terminated, but the pay is $15 for every hour worked in excess of 1500 hours in a month. So now you are supposed to calculate that amount. Okay, so now we can see that as per the information given in this question, so what is the right answer according to this information changed? So look at this answer. 57,000 is the right answer according to the information available, right? So if it is paid like $15 per hour in excess of 1500 hours, then this is the calculation done, right? So we know that $800, that is the excess amount, and total is the $4,500. So 4,500 into 10, like we have a 45,000, and 800 into 15, that we have $12,000. So total will be $57,000, right? So that will be the direct labor budget, right? Now, next, now we are just going to calculate about the manufacturing overhead budget. So what we have calculated since for, we have calculated direct material budget, direct labor budget. Now manufacturing overhead budget will be calculated now. And after then we will calculate a selling and administration expenses budget as well, right? That is the fourth point. But now we are at the third point. So now in this case, Royal Company uses a variable manufacturing overhead rate of $1 per unit produced. Means whatever the number of units that are going to produce, $1, that is a variable cost, right? So now the fixed manufacturing overhead, that will be 50,000 per month, includes $20,000 for non-cash cost. So non-cash is that cash is not involved, but that is also one of the expenditure. So that is known as the depreciation, is a non-cash expenditure on the plant. So look at this. We know that we have these units for the month of April, May, June, production units, and one is the rate. So at the rate of 1 overhead. So variable manufacturing overhead rate is given. Variable manufacturing overhead cost is calculated. And after that, we know that fixed manufacturing overhead, that is the $50,000 will be added. And this is the result, the total manufacturing overhead cost. Now, this is the total manufacturing overhead cost will be there, no doubt. But actually, we need to calculate here how much cash is required, right? So how much cash is required? It means if the $50,000 that we have calculated and estimated, that is the fixed overhead cost, it includes depreciation cost. So depreciation is $20,000 each month, that is calculated. So we have subtracted this one, and cash disbursement, right? So it means cash will be distributed or cash will be paid, right? For the manufacturing overhead will be like 191,000 rupees, or sorry, dollars. So depreciation is what? Depreciation is a non-cash charges. So this is what we have calculated. So we have calculated that how much money is required, how much cash is required for making payment for the manufacturing overhead. Now we come to the next point, that is ending finished goods inventory budget, right? So finished goods inventory budget will be calculated. So that will be calculated in the month of June 30th. That is ending finished goods inventory budget. A Royal manufacturing overheads is applied. So at Royal Company, manufacturing overhead, that we know that how to calculate, is applied to units of product on the basis of direct labor hours. So it means direct labor hours. So we should know what are the direct labor hours. On the basis of that, we will calculate the manufacturing overhead, right? Manufacturing overhead rate we will calculate. So finished goods. So let's have a look. So what we have in this case, we have here direct material. So if you talk about the direct material cost per unit, So first of all, the quantity. Quantity, we know that 5 kilograms are material is required to make 1 unit. And what is the rate given? So rate is a 0.40, 40 cent. So when we calculate $2 is the direct material cost we have. And second, direct labor in hours, we know that a 0.05 hours is already given for the direct labor. And what is the cost per hour? Cost per hour is 10, because for the labor we calculate per hour. For the material, that we calculate according to the denomination, according to the criteria, means a pieces or a kilograms. So here that kilograms are there. And manufacturing overhead. Now, the third point is the manufacturing overhead. So manufacturing overhead, that we will calculate on the basis of what, which is the criteria given, that total manufacturing overhead for the quarter is 251. So from where this 251 has calculated, and total labor hours. So both these figures have been calculated from the previous slide. You can see here. So 251. So look at this, 251,000. This is what? This is a manufacturing overhead. So manufacturing overhead is also here. And second, how many hours, total hours are required? So that is also available. So we can say that the total number of hours that is required, right? So here 5,300, right? So 5,300 required, that is to be paid. And labor hours required is 5,050. So look at this. So to calculate, the manufacturing overhead, that we have here, total labor hours required. So total labor hours required is 5,050. So with this much of time, that production can be completed, right? So with the required units that we have already set and budgeted. So 49.70 per hours, this is what, this is the manufacturing overhead, right? So 49.70 per hours that we have here. And for 1 unit, how many hours are required? So 0.05 hours are required. So 0.05 hours at the rate of 49.70 is a manufacturing overhead, and total will be 2.49 per unit. So 4.99, that will be the total production cost per unit. So now we have calculated production cost per unit, which is available over here. So now we should know what is the closing inventory unit. So the closing inventory unit, that will be here, uh, that will be 5,000 units. So from where this 5,000 that has calculated, that I can show you the closing stock. So at the beginning, when the production budget was created, so when the production budget was created, then I can show you here. Right. So yeah. So add desired ending and inventory. So this is the $5,000 is what? This is the closing stock for this quarter. So closing stock for this quarter. So $5,000. So here, this is the closing inventory, right? So let's see. Right. So here, ending inventory means, if we talk about the inventory here, means the finished goods we are talking about here, right? Finished goods at the end of the period. On June 30th, that we had 5,000 units here. So when we talk about the 5,000 units, you will see that, right? So 5,000 units multiplied by 4.99 per unit, the 24,950 is the right answer for this. Ending finished goods inventory expenditure means the cost. So, so we have here this. What is the value of the June 30th ending finished goods inventory? So the ending finished goods inventory will be 24,950, right? Okay. Now next, so we have calculated the ending finished goods inventory budget, right? Now we want to calculate the next selling and administration expenditure budget. For the selling and administration expenditure budget, we have some information available, which is in front of you. So variable selling and administrative expenditure that are 0.50 per unit sold, right? So 0.50 per unit sold. So this is what this is the variable expenditure, and fixed selling and administrative expenditures are 70,000 per month. Okay, so two figures that we have here. The fixed selling and administrative expenses include 10,000 cost, means primarily depreciation that are not cash outflow of the current month, means depreciation will be deducted. So it's a straightforward here that we have this information like $20,000, sorry, 20,000 units that we have, multiply by 0.50, that is the variable cost. Total variable cost is this much, fixed cost that we are going to add it, minus that we are going to subtract the depreciation. This is $70,000. That is the disbursement for selling and administration. This is this calculation is for the month of April, and same way that you will be going to calculate it for the month of May, June, and quarter. So I am giving you some time to calculate this one, but you need to have some previous data as well. But for now, so what I'm going to do, I'm just going to complete this answer for you. The reason being, like for May and June, that you need the previous data. So look at this. The question is, what are the total cash disbursements for selling and administrative expenses for the quarter? Right. So we need to calculate for the month of May, June, and July. Right. So this is April, May, and June. Sorry. So now we have the answer is here $230,000. So look at this. We have 20,000, 50,000, 30,000. So this is the data. We total is 100,000 units, and now we have here 0.50, which is given variable. This is the variable cost minus uh, plus fixed expenditure or fixed cost that we have calculated. Then after then non-cash expenditure depreciation is deducted. So less $230,000. That is the selling and administrative expenditures budget. Okay, so next is a cash budget. Now we want to calculate the cash budget. How much cash is required, right? So we have some information for this, means some opening balance of cash is required, right? And some cash we have received, right? Or some of the cash is a disbursement, means like we will pay, or we have paid during the month. Hmm? So that is the disbursement. So disbursement maybe like a direct material, direct labor, manufacturing overhead, selling and administration overhead, right? So all these are the money that cash we have already paid or we are supposed to pay. Now next, how to calculate all this? So cash budget, if we calculate that, will be composed of four major sections. The first one is the receipt. How much money we will receive in the month of April, May, and June. Okay, and how much money that we will uh, distribute, or we will pay, or we will uh, disburse, right? Then we will see if we will be having excess cash or less cash, mean deficiency. If there will be excess cash, then it's all right, no problem. But if there is a less cash, then from where we will get that cash? Because we are not going to shut our company down, right? Though if the cash is not there, but there is some limited period of time, and that particular period of time we will have to pay money for our direct labor or direct material, and manufacturing overheads, then selling and distribution overhead. These are the four major points, and expenditures, right? So then financing is the required. We will take a loan, or maybe from the bank or from the credit union, maybe on some percentage, maybe like a 10%, 20%, or 15%, whatever it is available. Now, it's a very simple way. If we have cash at the beginning, no doubt we will be definitely will be having some cash in the month of April, and we will be adding some of the money, right? Right. So how we will add? When we sell some product, definitely we will receive some money by selling some of the products by sale. In our case, that definitely we will add, right, in the month of February. It was $170,000. That was the cash collected, right? So now we can say that total cash available before financing. Then disbursement means the cash paid. Disbursement, that I explained: direct labor, direct material. That then we have manufacturing overhead and selling and administration overhead. So all these that we will be deducted. All these, the total of all these will be deducted from here. If excess or deficiency of the cash available after the disbursement, that will be written here. Now look at this. Some of the information is already we have in front of us. So if in case if there is a shortage of cash, then the line of credit the company has used, right, and will use 16% rate at that time. If they will be using for like $75,000, right, or maybe up to $75,000, they will be paying 16% rate of interest per year, not per month, right? So we will calculate dividing by 4, because there are 4 quarters. So for 1 quarter, how much if there is a loan, right? If there is a deficiency of cash, only in that case we will have this backup plan. Now maintains a minimum cash balance of 30,000. It means $30,000 cash. So they are planning to maintain every month. Means if you talk about April 30th of April means the closing date, last day of the month. The company have a plan that they should have at least $30,000 cash. Okay, so this is what they have assumed and what they have calculated and budgeted in their mind. So borrow the first day of the month and repay loans at the last day of the month. It means if they are going to borrow some money, right, so they will be going to borrow from the very first day of the month. I mean, let's say May 1st of May and May 31st, right? So 31st of May. On the 1st of May, the company will take loan if there is a deficiency, and on 31st of May will be repaid for full 1 month. Cash pays a cash dividend of 49,000 in April. So company decided today that the company will pay $49,000 dividend to its shareholders. Mean dividend to its all the employees or a shareholder, right? Okay, so this is also one of the expenditure. Now, if we talk about the purchases, so the company is planning to purchase some of the equipments, $143,700 in the month of May and 48,300 in June, and definitely they will pay in cash. Okay. Now, company has April on 1st of April cash balance of $40,000. So now we are going to calculate the cash budget. So first of all, if there is the opening balance, definitely we will write opening balance plus received minus paid. And if there is a surplus of or deficiency, we will calculate the loan and how much loan is required, and percentage is 16%. So let's have a look on this. So we have $40,000. So $40,000 is what? $40,000 is the opening balance, and $170,000 that is the cash collected, and $210,000 is the total cash available disbursement. So 40,000 is the direct material. Then we have direct labor, then manufacturing overhead, then we have selling and administration expense or administrative expenditures. So these are the cash that we will pay. So total of all these, right? Now in the month of April, if we say whether we have purchased something in the month of April or not, look at this. No, we have purchased in the month of May and June, right? So we have planned to buy something, some equipment. So not in the month of April, but in the month of April, cash dividend is there. Let's see what to do. Now we have all these figures. Now next is the direct labor budget. So we have direct labor budget, we have manufacturing overhead budget. Now we have selling and administrative expenditures or expense budget. So all budget that we have calculated here, we have written here. Now look at this. 49,000 dividend they have planned to pay in the month of April. So this is also that we have calculated here, and the total is 230,000. 230,000 is the total disbursement. It means 230,000 cash is required in the month of April, but we will collect $210. It means there is a deficiency of cash. There is a shortage of cash, right? That will be $20,000. So $20,000 that will be collected from the line of credit at the rate of 16%. Okay, so if we calculate that $75,000, not 75, this is 20,000. So we have $20,000 because this is the shortage amount. So $20,000 will be the shortage amount, and we need to calculate accordingly for number of days, that for how many number of days or how many number of months that we use that amount. Okay, so let's have a look. Now we have, because Royal maintains a cash balance of 30,000, right? The company must borrow on its line of credit. It means the first is $30,000 positive cash should be there. The cash balance should be there in the month of April, but we don't have. But we have negative balance. It means $30,000 is also required, and $20,000 this is also required because this is the cash shortage, right? It means the company need to borrow $50,000. Let's see. Financing $50,000 the company will borrow, and if the company will borrow $50,000, then $20,000 that will be paid because it's the negative balance to pay this one, and $30,000 that will be the total ending cash balance every month. Here will be every month, right? So in the April month, $30,000 will be the closing balance in this way. So this is what that we have calculated the cash available and at the end of the period. Total financing and is 50,000 and ending cash balance is 30,000, which is the required, and we have a plan for this. Now, for the month of May, the same thing that we have done here for the month of May, exactly everything, but here you will see the difference. 143,700 is the equipment purchase. It means the cash has come, this much cash has come, because this is the 30,000 that we have collected from the closing balance of the April months, will be the opening balance for the May. Closing balance for the May will become the opening balance for the June, like this. So here $400,000, that cash collection from the sale of goods that we have calculated before. Now, see, this is the cash. You can see that $30,000 cash is excess, means 430 minus $400,000. $30,000 cash is here. It means there is no need to take money from the line of credit, because this was our requirement and we meet the requirement, right? So because of the ending cash balance is exactly $30,000, Royal will not repay the loan this month, right? Okay, so in this case that we have this much of money. So the money which is taken from the bank, that was 50,000. So in this case, uh, the company is not having enough money. 30,000 was required, 30,000 is here, right? But we will not have enough money to repay this $50,000. So this is what exactly this statement is saying. The Royal will not repay the loan this month, because in this month only 30,000 positive cash is there. We need to have more than that. So according to the condition, $30,000 should be the ending cash balance, which is exactly here. Now look at this. What is the excess or deficiency of the cash available over the disbursement for the June? For the June month, the what is that we are going to calculate here. So how to calculate, and that I'm just going to explain this one here. 95,000. So 95,000 is what? So 95,000 is what? This is the excess amount, which is here, right? So it means how to calculate and how they have calculated $95,000. So that I'm just going to show you. Look at this. Now we have the June month data. Opening closing balance of this definitely will be the opening balance for the June. And we have this add cash collection. So this is the cash collection, 335,000. Then we have all these expenditure and 48,300, which is also given in the question, that equipment that were purchased in the month of June by the Royal Company. The total is 270,000, and here 365,000 minus 270 is $95,000 cash available over disbursement. So this is the positive cash. It means uh, in the month of April, we borrowed money. We took a line of credit of $50,000. This month we have enough money. So this month that we will pay, uh, we know that we will pay at the end of the month. This is the condition. It means end of the June, means April, May, and June. It means for the 3 months that we have used that $50,000. So we know that the $50,000, if we multiply the $50,000 into 16%, it will be $8,000. And $8,000 for this is the 1 quarter. So 1 quarter means like if you say divide by 4, that would be $2,000. That is the only interest we have calculated on the basis of the percentage given. Okay, so look at this. At the end of June, so this is June month, Royal has enough cash. to repay the $50,000. So Royal is having $50,000 excess money, no doubt, because $95,000, this is more than enough, because we need to have $30,000 only, which is the condition. Okay. So now in this case, what is going on? The $50,000 definitely the company will pay in the month of June end. So plus interest 16%. Okay. So now in this case, $95,000 is the cash available for disbursement, and for the financing, $50,000 and $2,000. $52,000, which is total financing, will be subtracted from this 95,000 minus this one 43,000. So $43,000 is available in the month of June. 43,000 is available in the month of June. So now, if we talk about the quarter, right? So in the quarter, we will see that 45,000. How this 45,000 has come, right? For the quarter. So for the quarter, $45,000. How this has come? So this has come because like $95,000 that we have excess amount minus $50,000 that we have paid. So minus $50,000 that we have paid, and now we come to know that 45,000 is cash. 45,000 is cash at the beginning of the quarter. At the beginning of the quarter, right? Okay, so now we have here at the beginning of the quarter is a $45,000 available. Then we know that like the 50,000, this is the total of 50,000, 50,000, 2,000. Then it's a negative 2,000, and the closing balance is the 43,000, which is here, right? So always that we calculated this way, the 43,000, like April, May, and June. June is the cash, ending cash balance is 43,000. So 43,000 is automatically coming here, right? So this is the calculation of 50,000, 16%, 3 months divided by 12 months is equal to 2,000. Borrowing on the 1st of April and repaying of the June 30th. That we have calculated. Now, cash budget is also created, right? So after we complete the cash budget, we can prepare the budgeted income statement for this company, for Royal Company. So budgeted income statement, it means how much income that we have. So we know that 100,000 units at the rate of 10. So the total amount will be 1 million, means 10 lakh. Cost of goods sold, we know that we calculated 4.99, that was the cost of goods sold for this much of units. Then we have 499,000 dollars here as the cost of these goods sold, and this is the margin, means like gross profit, you can say. Selling and administrative expenditure that we are going to deduct it here, selling and administrative expenditures. Then operating income minus interest expenses, that is the net income. We will have 239,000 that we have calculated. Now the last point that we are going to explain here is the budgeted balance sheet. So we have current assets, and we know that we will be calculating the fixed assets. The total will be the total assets, and on the other side we will look at the retained earning, account payable, and common shares. So Royal reported the following account balances prior to the preparing its budgeted financial statement. So land value already they have like $50,000, and common share is $200,000, right? So common share means the money which is collected by the company from selling of its share to the shareholders, and invested money in the business. Retained earning means like this is the amount of retained earning which is already they have prior to making this budget. Okay. Now, what is next? So next here is the Royal Company budgeted balance sheet. So for the balance sheet, current assets, we know that the cash we have 43,000, right, at the closing, which we have just calculated. Account receivable is the 75,000. Then we have raw material inventory is the 46, because like we know the 5,000 units we have, and this is the stock. Stock are the assets. Stock are the assets. We should know what is the raw material stock. Raw material stock is this much. This is the rate. And finished goods that we have here. So raw material and the finished goods, that is the 24,950. So that is the finished goods inventory that we have here. So next we have here, like for the property and equipments, means all the fixed assets we have. Land is 50,000. Then equipment that we have assumed like 367,000, and total property and equipment is 417, like $417,000. So we know that total assets means this one, like current assets plus property, plant, and equipment, PPE. So the total is this much. Account payable is 28,400. So that we have calculated on the basis of the June month purchase. 50% of that will be covered, and 50% of that will still be payable, right? Due but not paid. Common stock that we have at $200,000, means I'm talking about the shares, common shares. Retained earning, that is the $336,000 and 150. So this is what this is how we have calculated. So we have calculated on the basis of the opening balance. So opening balance of the retained earning was like 146,000 to 150, right? And plus we have added the profit, right? So that is the retained earning here, 336,150. So look at this. Beginning balance was 146, 150, and the net income will be added, and the dividend that we have, that we subtracted the dividend as well. And this is the rest of the amount, and total is the total assets are equal to total liability in this case. So this was a really very good example that I have explained, and which is a self-imposed budget. And a self-imposed budget is what? So self-imposed or participatory budget is a budget that is prepared with the full cooperation and participation of managers of all levels. If there is a manager in the company, not only one manager will be there, there will be number of managers in the different departments, and also in the different levels. If all managers working together with the full cooperation, so that is known as self-imposed budget. Now we know that total participative budget system will have the top level management and the middle level management, then supervisor that we have. So all are working together. All are working together, having a proper flow of information and the flow of budget data. Responsibility accounting, what is that? The meaning of the responsibility accounting here is the manager should be held responsible for those items. So it means if some of the managers have taken decisions, those managers definitely should be responsible, should be held responsible for those items, and only those items that the manager can actually control to a significant extent, right? So what is the budget committee? So a standing committee responsible for overall policy matters relating to the budget, coordinating the preparation of the budget. So that is known as budget committee. So next we have here beyond budgeting, means weakness of a traditional budgeting system. Managers normally tends to regard a budget as a set in stone, right? And evaluating performance after the feared and resented means cancelled, which can lead to gaming in budget, right? So budgeting has become to be seen as a purely financial and can be perceived as a disconnected from a strategic objective. So every company have their strategic objective, the main goal of the company. So the budgeting, and definitely if sometime the managers will use their less information, their personal they can use some informations at the time of making budget. There should be some biasness or irrelevant data can be calculated, right? So for making the budget, that may be some of the limitations or weaknesses of the traditional budgeting system. So now traditional budgeting tends to have a functional orientation, and whereas the recent management thinking is more process and cross functional oriented, means process oriented. So given the pace of chance that organization face is a static budget relevant. Beyond budgeting is it's a round table. It's like BBRT. So beyond budgeting round table has recommended a model. This is one of the model that uses uh, relative performance targets and emphasize the principle of strategic management and empowering employees. So it means in this case, the organization will be uh, working for making the budget and giving some authorities and powers to their employees also, and having a proper coordination and cooperation in making the budgets. So this method, beyond budget, is a very good method of budgeting. Key principles are that, so set challenging relative performance targets, adopt continuous and inclusive planning, right? So there should be proper planning at the time of making budgets, and use the rolling forecasts, use market like structure for coordination, decentralize resource management, and control through self-regulation and transparent information. So information should be available to each manager so that they can give their views about the setting of the rates and units and everything. Use low powered incentives lines to group or organizational performance. So this is all about the beyond budgeting. So chapter summary, we can say at the end, what we have learned since for that is the budgets that help to communicate plans and force managers to think about the future, allocate the resources and evaluate the performance as well. So each budget in the master budget helps managers throughout the organization work towards the same vision. The cash budget helps identify the cash shortfall and encourages managers to plan for them. So in this way, that in future, if there will be shortage of cash, there should be a backup plan, and there should be some proper planning for the cash. So cash planning. So budgeted income statement and balance sheets are definitely helpful in constructed for the master budget, right? And involving managers in budgeting process definitely that helps to create a successful budget.